Welcome to Distribution Talk with Jason Bader, the show where we dive into the stories, struggles, and solutions from business owners and thought leaders in the wholesale distribution market. Hey friends, Jason here. In this episode, I had the pleasure of catching up with Roman Basi. He is the president of the Center for Financial, Legal, and Tax Planning. That's quite a mouthful. Really, their firm specializes in helping private business owners, put together estate planning, but not only estate planning, but transaction planning, succession planning. I mean, these folks really run the gambit of how do you manage that transfer of that business as you are coming to the close of your, of your career. And this is a big challenge for a lot of folks. I've met a lot of folks in their, probably 60s, into their 70s. And they really are trying to understand, what am I going to do with this company that I've grown and built? Or maybe they're in the middle of their career and they're looking at, what are my best options if I do want to sell the business? That's where somebody like Roman comes in. I mean, you'll hear during our conversation that, he is just a wealth of knowledge, and he and his father have been practicing this, for decades and decades. I mean, they are really, really good at this. And I think, as the owner of a business and someone has put their blood, sweat, and tears into these things, you owe it to yourself to have a professional on your side to really guide you through that ending process and that transfer process at the end of that career. So, really a pleasure to speak with Roman and hear about some of the different ways that you can protect yourself from onerous taxation, but also, really get yourself ready for, the hurdles that come whenever you move a business into another entity. So I really enjoyed the conversation, and I hope you do too. This episode was brought to you by my friends at Profit2. A couple of years ago, I was introduced to Profit2 through a client who had been working with them for over a year. This client had been struggling with improving gross margins and was looking for a service to help them recapture some of their lost opportunities. Through their work with Profit2, it took about a year, but they were able to bump their gross margins by almost 2 points. For this distributor, and frankly for anyone in the business, this margin enhancement was a big deal. Beyond the pricing service, Profit2 has started helping clients look at cost and rebate management. If you want to discover hidden margin opportunities, come take a look at what Profit2 can do for you. Learn more at www.distributiontalk.com/profit2. That's profit with a number 2. Well, hey, Roman, welcome to Distribution Talk. Thanks for taking the time to be with me.
Thanks for having me.
So one of the things I love to do is, the show really highlights the people side of this, who got involved in distribution and why. But if you wouldn't mind giving us a little background, how did you find yourself in the succession business, and give us a little history lesson if you wouldn't mind.
Sure. I'm an attorney. I'm a CPA. I'm a real estate broker, as well as a title insurance agent. I joined my father's firm back in the late 90s, 1997 to be exact. And my father was a retired professor from 2 universities and was researching and writing for a lot of associations across the country, the distributional associations being some of them. And I joined him in 97. And lo and behold, I didn't realize where my career was headed then. I had a bachelor's of science degree, and I was headed to possibly be a radio DJ or be a park ranger with my biology degree. I didn't have much going for me. So
yeah, that's a little diverse there.
Very diverse. So
yeah.
I went back to school and I got my master's in business administration. I do have an MBA. I started running our real estate operation, which ironically, I know we'll talk a little bit about real estate later today, but I started running our real estate operation. Then I decided to go to law school, and then I decided to get my broker's license, and then from there get my CPA license. And so little by little, it turned into this merger and acquisitional consulting world with my father as our practice developed over the years into what it is today. And sitting here now after 26 years of being in the industry, our focus is a lot of merger and acquisitions of privately held companies, although we do a lot of succession planning and strategic planning and tax planning for companies across the U.S. So really that's how I got here today. It was my education kind of drove me into the field along with my father. And surprisingly, he and I worked out pretty well. I'm one of 6 children, and I'm the one that stuck around and worked with him. And now I own the companies and I run them. He's still a big part of our company, but I took him over about 8, 9 years ago, and I run them to this day. So that's how I got where I am now.
Yeah, well, I can recall, your father really, it wasn't really more focused on estate planning, tax and estate previously.
Yes, that was our main focus. Was a lot of estate planning, tax planning with the new tax code that came out in the 1980s. So that was really the focus. And then now over the last 5, 10 years, it's just been so transactional as we've headed into these new eras. But again, now with interest rates going up, deals slowing down, we're seeing a lot more succession planning issues and elements come up in our practice.
For sure. And, in the distribution world, it's kind of one of those ever-changing worlds, Somebody gets acquired and then others want to spring forth from that and do their own things and build their own business. It's one of those recycling types of businesses, or industries, I would say.
Yes, absolutely. And that's one thing we like. And we even represent a lot of new owners in the industries, and we incubate them, so to speak, because we are here for their success. We want them to be successful and to see all the decisions that have to be made early on to prepare yourself to be successful in the future. And then we're there at the end when they're transferring or they're succeeding to the next generation or what it may be. And that's really the goal of a lot of those startup entities that we work with, is to make sure that we've got them on the right successful track. So years from now, if they do decide to transfer it or sell it, we can structure it in the best way legally. We can structure it the best way to minimize their tax liabilities, and we can structure it in the best way for their families and their employees.
Roman, I think a lot of these folks, they come out of, they worked for a company, they got acquired, and they decide, I don't want to work for this larger entity. So they bounce off and do their own thing. As you said, they kind of become these new owners. And a lot of them have absolutely no clue as to what the finish line looks like, or really that planning process and making sure they are on that right track.
Yeah, and education of what's going to happen is the key for those types of owners and businesses. I can't say it enough that owners can be very frustrated when they go into discussions on succession planning or transactional planning when they don't know what they're going to expect. Give a good example is I had a client out in Portland, Oregon area that we were getting ready to sell his distribution company. It was a very large company. And when he was presented with a 60, 70 page purchase agreement that none of it really pertained to his business, he wanted to kind of mark the whole thing up and turn it into a 2 or 3 page agreement. And that just doesn't fly in the industry. It's not how the M&A industry works. And he was so frustrated throughout the process because he really didn't understand what to expect. So one of the best things that you can do as a business owner is educate yourself on the process. What does it mean to be doing a succession plan? Is it a written document like ours is, a written step-by-step set of instructions on what we recommend that you do? What is a succession plan? How is it written? What does it cover? What's it going to take from you, the business owners, or you, the employees of the company? And then the same thing for a transaction. An owner really needs to understand how time consuming they can be, the records they need to have, the fineness and the accuracy to all those business records at the time they go to the market and the time they go to a closing, and even after a closing. In fact, I'm dealing with a situation today where we closed a deal about 2 weeks ago. There were 2 majority owners and 1 minority 3% owner from a previous marriage. This company's been in business since the 1980s. They didn't hold meetings. Now this shareholder is asking for minutes, resolutions, decisions that were made in the past. Now that he just found out the company was sold, he's asking for all this back documentation that they simply don't have, and they can't create it legally. So preparation, knowledge, and understanding it's going to save you, the owner, so many headaches when you do come down to that final point when you're ready to transfer your business.
It's funny, when you bring up those stories, I can think of little transactions I've seen over the years, where it is that somebody, maybe they wanted to retain a key employee, and so they gave him a small percentage of the business, not really thinking about the long-term ramifications of that. And then it comes to that transaction, and it's all of a sudden now they have to get the blessing of this maybe 5% owner. It becomes very, very difficult at that point.
It does. So preparation and knowledge and understanding the process helps, because if you go into a deal and you say, okay, we're going to transfer the company, are all my corporate minutes in the record book? Do we need to get waivers of notice from the minority shareholders now before we find out it's too late? So it's these small little types of things that can go a long way down the road.
So Roman, thinking about the succession planning, and and a lot of the businesses that I deal with, and certainly you all do too, are family held, privately held family businesses, and they have a desire to move that on to maybe the next generation, if possible. What are some of the best ways to kind of get ready for that, and really when should that planning start?
I sit here and I run a couple different companies myself. And when you ask the question of when should the planning start, it's never really too early to think about the options for the planning of the succession of the business. I sit here and I have two daughters, aged 20 and 22. And right now, neither one looks to go into any of our companies. We thought they were going to go in a couple of years ago, and now it looks like they might not. But it's never too early to start that discussion, to have those ideas on paper, to say, okay, if things are the way they are right now, what does my succession plan look like? And they usually start with a valuation of the company. You've got to know what the value of your company is. And it does a lot of things for you if you prepare a proper business valuation. You're going to clean up your financials by doing a valuation. You may go back 3 years, 4 years, or as many as 5 years. And during that process, you're going to clean up your financials. You're going to be looking at things like seller discretionary expenses, or what we call add backs in the industry.
Add backs, sure.
Not necessary to run the business, or what was a one-time expense. You put a new roof on and you expensed it in 1 year, or you put new software into the business and you expensed it all in 1 year. But we're going to add that expense back when we do the valuation to give you a more truer picture of what your company's worth. That's where all succession plans start, because we can't create a plan for you unless we know the value of the business. We understand your standard of living as the owner and the standard of living you want to retain at the end of the succession plan. Again, whether it's transferring it to the employees, key employees, family members, relatives, maybe there's a competitor involved, or you're going to sell it on the open market. And when we say succession plan, and I know I'm on the podcast today as a guest, and I don't want to be a sales pitch. I try to call myself educationally entertaining whenever we're giving a speech or a podcast.
Okay,
And I want your listeners to know that. I don't want this to be a sales pitch of our services, but a succession plan should be a written document with a set series of steps as to recommendations for your business, how to run it now, how to run it in the future, and how best to transfer it down the road if and when you're ready. And things like we may look at, are we going to sell the company to somebody? Are we going to gift the company to somebody? Are we going to sell stock to somebody? Are we going to sell an asset? What's best for your company? And so in this set of recommendations, when we write this succession plan, we lay them out. We're like, okay, you are an S corporation. Maybe we want to switch you to a C corporation and hold on to that for 5 years. And then you have something called qualified small business stock under Section 1202, and we can sell your stock tax free. These are kind of things that we will put into the succession plan. Or, as we'll talk about a little later, maybe real estate is in the name of the company, or it's in your personal name. Well, we're not going to recommend that. So in the succession plan, we're going to tell you, let's form a limited liability company. Let's deed the property into the company. Then let's have a lease from the LLC back to the operational company. So now you can take more advantage of the rental deductions. This is how a succession plan works. It is this step-by-step steps series of recommendations in a written document. And then you, the owner, can look through it and say, okay, let's do items 1, 5, and 10. Let's not do 2, 4, and 6 right now, Roman. Let's hold off on those. And that's how these should look. So don't just say, yes, I have a succession plan. My daughter or my son works on the company. That's really not it. How are you really going to transfer it to them? What's it going to look like when you transfer it? Are you going to minimize your tax liabilities? And are you, the owner, going to retain your standard of living? And can the company be a going concern going forward? You're not going to put the company in a bad position. So sorry, probably a long answer to the question.
It's a great answer, because I mean, it really kind of shows that there are so many different options. But I think the key takeaway is start early. We never know what life is going to throw us, what curveball is going to throw us. So earlier the better. I mean, absolutely.
The cleaner you can have your financials cleaned up, and even if, again, even if you're
Yeah.
an owner and you're operating the business and you are taking out discretionary expenses, at least you start to categorize them every year. You say, okay, I bought a new vehicle. I really didn't need it. I expensed it in 1 year. Maybe it was over 6,000 pounds. I wrote it off in 1 year. But you start those categories, and every year you can update that list. And yeah, one thing that's not on my bio is I'm an Eagle Scout, and the motto of an Eagle Scout is to be prepared. And that's what I always
Yeah.
tell everyone is the more prepared you can be going into the drafting of the plan, the more the plan is going to cover for you and the more accurate
Hmm.
it's going to be.
Yeah, absolutely. I mean, I think sometimes, as you had mentioned earlier, that you thought maybe that one of your daughters was going to be coming into the businesses or whatnot, and then it looks like she's not going to. Now, in that situation, I mean, I've seen a couple companies where they've just the owners held on to the stock, or maybe they've had a board that held on to the stock and somebody else ran it. But in that situation, when you don't have clear successors that want to take on the plan, is an ESOP a good option for these folks?
Absolutely. An ESOP, an employee stock ownership plan, can be a good option for the right businesses. And that's
Yeah.
where the employees are going to be able to buy into the ownership of the plan. And you, the owner, are going to be able to eventually get yourself out through an ESOP. If the employees, if there's not a lot of capital around and there's not a key employee that's going to sit there and buy the entire company, then an ESOP can be a very good way to transfer the business. The one downside to an ESOP is that it requires a valuation of the company every year. That
Yeah.
Not that that's expensive. Yes, a valuation can be a little costly up front. Then the updating of it should not be that expensive. And that also brings up the concept, though, of alternatives. So my written succession plan, the way it would look right now is, yes, if the girls wanted to take over the businesses, here is the way I would do it. Would I sell them stock? Would I gift them stock? Would I sell
Hmm.
them assets? Okay. And if they don't want to take over the business, is there a key employee that would buy into either one of the companies or are already bought into the companies? And then finally, no, if there's not, then the third alternative is, do I want to put it on the market? And if I want to put it on the market, this is the way I want it to go. Again, all of these have these relative other items that go along with each alternative. But to have those in writing and have a plan to say, okay, if my children come back into the business, then this is the way I'm going to have it go down. Maybe a stock, typically, for those listening, typically the way we set up an internal family or key employee succession plan with a stock redemption,
Okay.
where the company is redeeming the stock of the owner over a period of time on a promissory note. And we either put the key employee into the position of ownership right away or the family member into position right away. Or, again, as you just mentioned, there can be an ESOP in place where the employees are buying into the stock ownership of the company. Or we can go into gifting. Gifting right now is still very, very viable because our federal exemption is so high and our
Hmm.
federal exemption is set to expire. Remember, it's 5 million adjusted for inflation, doubled, and then we have portability between spouses. So we're in the $25 million range for the federal estate tax unified credit right now. That's going to go away in the next couple of years. So we are still seeing companies doing some gifting using up some of that unified credit in their succession plan and getting their ownership out of their names and into their family or key employees' names. So those are just some options.
No, those are great options to consider. And I think really, part of the discussion, Roman, was really to, kind of tell people that there are some other options besides either you sell it or you hope that you have a family member take it over. I mean, there are
Right.
a lot of other ways to go about this.
There are, and that's why one thing we look at, and anybody listening is welcome to look at our website. We've got a 20, no, not 30, a 32 item list now. Our list keeps growing and growing. Those are the things we look at. We want you to see the big picture when you're looking at a succession plan. There's
Yeah.
32 items on our list, and we want to see those items because we want to consider every option possible for you, no matter what you think it is. You may say, well, Roman, I really don't want to sell. I want to work till I'm 80, and then I want to do this and this. All right, then I've got to work those concepts into your plan. If that's what you want
Sure.
as an owner, I'm going to work those into your plan to make it work for you and to show you mathematically and from a tax perspective how that's going to work within the plan.
Shifting gears here a little bit, you mentioned the potentially selling the company, kind of moving over to that transaction. side of this. And you've done a ton of these, and you're continuing to do a ton of these right now. So as someone is preparing for that, if they've come to the conclusion, or the plan has come to the conclusion that, we are going to sell this entity on the open market, for example, or maybe even to an equity, private equity firm, what does that process look like? And kind of what are the big hurdles or, snake pits that these folks should hopefully avoid if possible?
Well, and again, I think the first step here is, and we've been doing this on every single transaction. And if you're working with a transactional person, hopefully they can do this for the business owner when they start to step into this transactional world. Is now we maybe know what our company's worth. We've done a valuation, or someone has provided us with a valuation, or the advisor has done a valuation. So we know what we think the price is, but what is the owner going to walk away with? And that's one of the first pitfalls most owners don't take into consideration. They say, oh, I'm going to sell my business for 3 million, 5 million, 10 million, 100,000, whatever it may be. And they don't really know what they're going to walk away with. And they don't really think about that until we get close to closing. That is one of the biggest mistakes you can make. Start immediately what we call our tax minimization analysis. And we do this on every single transaction, and every owner should be doing one. It is an entire waterfall of a transaction from start to finish, starting with the selling price of the business minus the expenses of the sale, things like broker's commissions, legal expenses, title work, accounting expense, whatever else you may incur. Then we have things on almost every deal that will adjust the selling price. And owners don't even know this. If there's going to be liabilities that a buyer is going to assume, an owner is taxed on the assumption of the liability. They don't think that. They're like, well, they took over this debt I had of 20,000 to this vendor, so I don't have to pay taxes on 20,000, and that's wrong. So we include that 20,000 in the selling price to show them the taxation of this, so they can understand they're being taxed on that assumption of liabilities. Most deals now, regardless of the size, have some type of working capital adjustment. Whether it's positive or negative, that can affect the selling price. So this is all in our very first bucket. Then we look at and this is why it's such a big mistake to not think about this before a deal closes. We then look at the structure. What's the best structure of the transaction? And keep in mind, we're framing all of this in our tax analysis, but we're showing the owners, okay, is an asset deal the best way to sell your company? Is a stock deal the best way to sell your company? Is there a hybrid of those? And believe it or not, there is. As some of us know, there's a hybrid called a 338H10, which is where you sell the stock of your business, but the buyer gets a stepped up basis in your assets. I'm doing one right now for $9 million on a property management company, and it's a 338H10. So there's a negative tax impact to a seller typically on 338s. So we're going to show the seller in this TMA, this tax analysis, the best possible structure for tax purposes. Then we now know what our taxes are going to be. And we're going to look at federal, state, and local, because you're going to be impacted by all three. We're not done. We put this net number in this TMA. And then we've got to say to the sellers, okay, now you've got to pay off your liabilities. Most buyers are going to require you to pay off all liabilities. That's not an expensive sale. Most sellers think it is, and they're mistaken. Now they see that number, they see the payoff of liabilities. We're still not done. We look at non-competes, earnouts, purchase price adjustments, consulting agreements, employment agreements, and real estate leases. So this thing really shows an owner what they're going to walk away with. Now they can go to the table and negotiate. Now they know, oh, the $8 million offer I got is not quite as good as the $7 million offer I got, because the $7 million structure is better for tax purposes. And that's what that shows them. Then sellers have to understand they're going to go into this process and they're going to get an offer, just like selling a house. They're going to get an offer. And that's just the beginning of most transactions. Now, once a seller has accepted an offer, they go into something called due diligence, and that's like discovery in a lawsuit. And this is what this is where the pitfall happens, because owners think, okay, I've given all my information now to the buyer. They have everything. Let's close the deal. And an owner doesn't understand that now the purchase agreements come in. When due diligence is done, the purchase agreements come in. We've got to go back into those due diligence folders and make schedules and documents and deliveries. And so that's what the biggest pitfall I find is that, again, owners are just not prepared for this lengthy, drawn out, deep diving process into their information. It's not that bad if you have the right professionals in on the transaction, but when you don't and you're unprepared, that's when you're going to have problems in the transaction.
Yeah, one of my close friends, as he was in the final throes of selling his distribution business, he said that he worked harder in the last 30 days, than he had in the last 10 years,
Yeah.
to try to bring everything together.
And hopefully the advisors that you work with understand that you're running a business. You, the owner, are running a business, and we know that. We know you've got to run your business. So we try to minimize the impact to you, but you've got all the information that we have to have for the deal. So that's another reason why you got to prepare yourself. You got to make sure you're working with the right people going into these transactions so that your downtime is minimized as an owner. I was about to wring the neck of my best friend yesterday. I found out he sold a company that he'd owned for a long time, and he didn't involve me, of course, because best friends don't, right? They try to keep friendship away from work. And I got an email from him, though, or a text message about 2 weeks ago, and he said, "Roman, I got the offer for the company. I want to put everything on equipment, right?" And I told him in the text message, I'm like, that is absolutely incorrect. You don't want to allocate all the money coming into your deal to your equipment. You're going to get hammered for tax purposes. It was just an example of not being prepared for the process and the terminology and things that go along with it.
Roman, thinking about just distribution companies specifically, is there any one challenge that you run into quite often, I'll put it that way, that you just wish people would know up front?
Yeah, I think the cleanup of the financial statements we run into on almost every single transaction where the owners will come to us, they're typically not audited financial statements. So they come to us and they say, "Oh, these are not ready," or I'm dealing with one right now out in Washington. And it took so long to try to clean up the financial statements for the owner that they lost their first buyer. Their first buyer walked away because time was dragging on and on and on. The most important thing you can do if you're going into a transaction, and also this goes along with this, don't give a buyer just raw financial data. That is another huge problem that I have in the distribution industry is the owners will say, "Well, here's my financials," without making any adjustments to them. We always give a potential buyer recasted financial statements. Those are your correct, adjusted financial statements. We've adjusted things in and out of them. We give buyers your tax returns so they get your raw data in a tax return, but we also give them clean, recasted financials. And that is probably the hardest and the most, my accounting staff would probably be smiling right now because I'm saying this. You got to stay on top of it monthly. As soon as a month closes, you've got to be able to provide your buyer with new, clean, recasted statements. They can't wait 3 more months for this month's statement. So that is the most important thing going into the market. Be ready, be prepared, and stay on top of those financials now during the deal until the deal's closed.
We spoke about, jumped on a little bit of real estate earlier, but, one of the things that, I was taught early on is to not have the real estate, for that operation inside of the business. I was always taught, to pull it out. And that's what, my family pulled it out of there. The real estate was never involved. But I've run into a lot of companies I've worked with that it is embedded in the organization. And I just think that's a mistake. But you're the expert on it. Tell me about this. What do you run into?
Absolutely. We run into that a lot where it is on the company's books. It is owned by the company, the operational company itself, or the owners will tell me, "No, it's a third party that owns it." Then come to find out it's in the owners' names themselves. Number one, for one purpose, first of all, we like limited liability companies for real estate ownership. There are tax benefits to owning real estate inside of a limited liability company. And there's a newer company, even more so than an LLC. It's called a series LLC. And to all the listeners, I practice what I preach. I have a series limited liability company. My father started our real estate investment company back in the 1980s. I sit here today and we own over 400 properties here in the United States inside of our series limited liability company. So if you have real estate at all involved in your business, it should be owned separately by an LLC and possibly by a series LLC. And that series LLC allows you to put different properties into different series, and the liability of one series does not cross over to the other.
I gotcha.
So you can diversify your liability, which is what you're doing as an owner by getting the real estate out of your company or out of your personal name. Number one, you've got a lot of legal liability. If it's inside the company, you got problems when you go to sell the business because it's in there. Do you want to sell the real estate? Do you want to keep the real estate? Now, if you want to keep the real estate, chances are you've got to remove it out of there before closing. That can be costly, that can be timely, and that can just muck up the deal. If it's in your personal name, that's one of the largest mistakes you can make legally. If someone gets hurt on the property, which you probably have incurred over time, but if someone gets killed and your insurance coverage is not enough, they're going to sue you personally. Or if you don't have insurance or your insurance lapses, they're going to sue you personally and go after your personal assets if that piece of real estate is in your personal name. Another pitfall I see a lot is people will tell me, well, I have an LLC and my real estate owns the LLC. And when I look at the actual deed, no one ever deeded it to the LLC. Maybe the lawyer set the LLC up, but they didn't do the actual deed and transfer. So we want to make sure that the underlying documents are supporting the legal structure that you created with that limited liability company. And then there's a lot of benefits for tax purposes. If you're not taking a rental deduction, now you can take a rental deduction from the company. You can shift it over into the real estate company. You can depreciate the real estate company. You've got expenses in the real estate company that you can get out of there. There are other rules that are beneficial, which go into active and passive income and losses. One reason why I hold a broker's license is because that classified me as an actively participating member of the LLC. And while we had losses, I was able to take my losses in my LLC and apply them directly to my W-2 ordinary income because I was actively involved in the management of my LLC. So yeah, I'm one of the proverbial people that had a little bit of a higher income, but didn't pay taxes because my active losses for many years while my real estate company was growing, those active losses offset any income I had whatsoever. So the licensure helped me, the fact that I had a professional real estate license, and the fact that I am very actively involved in the management of that company. Now my company doesn't have those losses any longer. Now it's in a more of a mature stage. So now that doesn't benefit me as much. But if your real estate investments are growing and you're in a growth stage of your company where you can take some losses in the real estate, you can utilize those losses because if you're passive, you can't offset your active income. You can only offset passive investment income. So that's one other reason why we like these in limited liability companies, real estate specifically.
You know, one of the things I found, Roman, is some of the companies I've worked with, again, looking at their P&L, when the real estate's embedded in the company, they don't charge themselves rent.
Right.
And so I look at it and I'm like, guys, you're delusional here. There is another piece of the expense that really, should be considered, but you're kind of cheating. You're making yourself look better than you really are operating.
Right. That's right. And that becomes a really big part of deals when someone says, okay, well, now I'm going to keep the real estate. I'm not going to sell it to you. And now I'm going to have rent involved. And so we end up having to recast the financial in a negative manner to show what the value is going to be with rent being involved. So that becomes a very negotiational standpoint. And you're right. It becomes 10 times easier to have that conversation if the real estate is already out of the company and you're already charging yourself rent. Now, all we're arguing is the value of the rent as opposed to rent being on the financial at all.
Right. Right. No, I just, I've seen that though, time and time again, it's like, well, no, we don't charge ourselves rent. I'm like, no, you really need to at least allocate something there to show.
Yeah.
But speaking of, thinking about buyers of these companies, would you say that most buyers of these, let's say again, privately held distributor, would they prefer not to own the real estate?
Yeah, I think in general, what we see in the M&A world and the distribution industry is that typically the buyers come in and they don't want the real estate or they don't want it right away. They'll want it down the road. In fact, we're closing a deal right now as we're having this podcast, and there's a lease in place that's just going to roll year to year, but it's got an option to purchase in it with a credit given for some of the rent paid. And we see that very often where there's a lease with an option to purchase. Of course, I'm a real estate guy, so I'm going to counsel my clients and say, look, if you're going to stay in the area and it's a good buyer, it's a very good idea to keep the real estate if you're the seller. It's the great residual income that you have the rest of your life if it's a good tenant. But you're right. Most buyers are going to come in because they don't want to deal with that piece of the funding. It's also more complex to buy real estate. All of the underwriting that has to take place, the title work that has to take place, and their requirements. They can get the deals done quicker without the real estate and then back end it later and possibly buy the real estate. And as we know in the industry, they try to package companies up and then eventually sell their packages down the road. And if real estate's involved, it muddies that up.
It does.
It's a lot easier for them to sell these as to package up different companies, have a nice tight package without real estate involved, and then boom, they sell them off. So that's another reason why we probably don't see as much real estate acquisition in the M&A world as we do elsewhere.
Is it fairly complicated to move the real estate out of the operating company into that new LLC, that new real estate? Is that a complicated process, or is that something that an owner can do relatively easy and deed it over to the next, to the LLC?
That's a great question. It's relatively easy, but there are some states that will tax that transfer, even though you may have the same ownership in the operating entity and the same ownership in the LLC. Pennsylvania is one state that will tax that. Then you have to weigh the consequences of, do I want to transfer this $1 million building? It's going to cost me $20,000 in a transfer tax. Most states don't have that rule, but you got to be careful for that. But other than that, you're setting up an LLC, you're quit claiming a deed over to the LLC. And if there's a mortgage involved, we sometimes will talk to the lenders. Sometimes we'll just ignore the lenders because their lien is still valid. We don't want them getting in our way necessarily. I kind of say that and I chuckle, but we can talk. If you've got a good relationship with your lender, then they'll know, oh, they're forming an LLC for protectionary purposes. Our lien is still valid. And on that note too, when I look at these succession plans as a whole, the back end of the succession plan is really estate planning. I don't want the real estate in your LLC in your personal name. If you're going to hold on to that real estate for a long time, now it's time to think about a trust. Do we want to put your ownership of the LLC and maybe even the business into an irrevocable trust? What age are you? How long have you ran the company? How long are you going to run it for? Even if you want to sell the company down the road, what age are you? Because when I look at estate planning and a succession plan, I'm looking at federal estate taxes and state estate taxes. Those two don't always line up. I'm looking at probate planning. I want to get everything out of your name if possible for probate purposes. And I'm looking at Medicare or long-term care expenses for the individual. Sure. Do they want to qualify for it? Do they want to privately pay for it? If I can remove things from your name and get them into trust for you, then I will do that within our succession plan that we create for you. We'll make sure that we got that back end covered. Like you mentioned earlier, our firm really started on estate planning and taxes. So now it's the back end of what we do, but it's probably one of the most important. You've sold your business or you've transferred it. Maybe you've kept the real estate, maybe not. Maybe you have a note that you're being paid on, and I want everything tucked away nicely into an irrevocable trust so the government can't get to it should something happen.
Perfect. Well, hey, Roman, I really appreciate all this. So obviously, incredibly knowledgeable about this. How does someone get a hold of you and work with your firm?
Well, the best way, our website is taxplanning.com. We've had that for many, many years.
I would say that's a pretty solid URL right there, man.
Kudos to my older brother. He got that for us back in the 90s, right when the internet was introduced to everybody. So it's taxplanning.com. We're on Facebook. We blog a couple times a week. My email is rbasi@taxplanning.com, or we have an info@taxplanning.com also, or you can call us. Our number's on the website as well. We usually respond the day you contact us, and we try to set up a phone call for the next day or within the next couple of days. We always try to jump on the phone first to kind of get a feel for what you've got going on, but that's the easiest way to reach out and connect with us.
Roman, I really appreciate it. And we'll link all of that in the show notes and make sure that everybody knows how to find you. And Man, I truly appreciate you coming on and taking a little time to explain this to us.
Absolutely. Thanks for having me. As everybody knows, I love talking about it. It's been a blast. So,
all right,
great.
man.
Thank you so much.
Hey, look forward to the next time we see each other.
Absolutely.
Thank you for listening. If you liked what you heard, consider sharing with your friends and colleagues. And don't forget to follow the show on your favorite podcast application. Links to sponsors, products, and services mentioned during this episode can be found in the show description area or at www.distributiontalk.com. Distribution Talk is edited and mixed by the brilliant team at the Creative Imposter Studios. This episode was brought to you by my company, The Distribution Team. We are a consulting services firm dedicated to helping wholesale distribution clients remove barriers to profitability, generate wealth, and achieve personal goals. To learn more about how we can help your company succeed, check us out at www.thedistributionteam.com.